The correlation collapse mechanism. How during moments of extreme market stress, assets that appeared uncorrelated suddenly move in lockstep, destroying the diversification assumptions that entire portfolios, pension funds, and institutional risk models were built upon. Systemic risk in global credit markets is not the risk you can see. It is the invisible web of counterparty obligations, rehypothecated collateral, and leverage chains that snap simultaneously, turning a contained crisis into a civilizational financial event. This is the analytical spine of everything that follows. Are down. Your money market fund, the one your financial advisor called cash equivalent, the one with zero risk on every brochure, is breaking the buck. The Reserve Primary Fund, one of the oldest money market funds in the United States, has just fallen below 1 plodred net asset value. For the first time in nearly 40 years, a money market fund, the instrument millions of Americans were told was safer than a savings account, had failed. What followed was not just a financial event, it was a revelation. Within 72 hours, global credit markets froze. Overnight lending between the world's largest banks essentially stopped. The LIBOR-OI spread, a technical indicator almost nobody outside of fixed income desks had ever heard of, spiked to levels that told every seasoned risk manager on the planet the same thing. The system does not trust itself. Here is the paradox that should shake every investor to their core. The instruments that caused this were not speculative penny stocks. They were not obscure cryptocurrency tokens. They were mortgage-backed securities, assets rated AA by Moody's, S&P, and Fitch. They were held by pension funds in Norway, sovereign wealth funds in Singapore, university endowments in Boston, and retirement accounts across Middle America. The most trusted, most diversified, most rigorously analyzed instruments in global finance were, at their core, a single correlated bet dressed up in 10,000 different labels. That is the Black Swan rule of systemic risk. It is not about the risk you can identify. It is about the risk hiding inside the thing everyone agreed was safe. And right now, in 2025, that same architecture, leveraged, interconnected, and dangerously correlated underneath the surface, is operating at a scale that makes 2008 look like a dress rehearsal. If you hold bonds, equities, real estate, or any credit-sensitive asset in your portfolio, what you are about to hear is not theory. It is the operating manual of the system you are already inside. Before we can understand the Black Swan rule, we need to establish the three financial mechanisms that make systemic risk in credit markets so uniquely lethal and so uniquely invisible until it is too late. Correlation breakdown under stress, modern portfolio theory. The framework taught in every MBA program, encoded in every robo-advisor algorithm, and trusted by trillions of dollars in institutional capital, rests on a foundational assumption. That assumption is diversification. If asset A and asset B do not move together, holding both reduces your overall risk. The mathematics is elegant. The problem is real. In normal market conditions, correlations between asset classes hold reasonably well. Equities and bonds tend to move in opposite directions. Gold tends to rise when risk sentiment falls. Emerging market debt offers yield without direct exposure to U.S. equity volatility. But under extreme stress, the kind of stress that defines Black Swan events, correlations collapse toward one. Everything falls together. In March 2020, as the COVID-19 shock hit global markets, U.S. Treasury bonds, typically the ultimate safe haven asset, sold off simultaneously with equities. Gold dropped. Investment-grade corporate bonds dropped. Even cash equivalents experienced liquidity stress. For approximately 2 weeks, almost every asset class on the planet moved in the same direction. The correlation assumptions that underpinned 50 trillion in institutional portfolios were simply wrong, and wrong at the worst possible moment. Nassim Nicholas Taleb, the statistician and former derivatives trader who wrote the Black Swan, identified this precisely. He argued that financial models systematically underestimate the probability of extreme event because they are calibrated to normal distributions. Markets, however, do not operate on bell curves. They operate on fat tails, and in the tails is where systemic risk lies. Rehypothecation and collateral chains here is a term that does not appear in mainstream financial news, but that every prime broker, every hedge fund operator, and every central bank risk desk understands intimately. Rehypothecation. When you post collateral, say, treasury bond, to secure a borrowing transaction, the institution receiving that collateral is, in many jurisdictions, legally permitted to reuse it, to post it again as collateral for their own borrowing. The same bond, the same piece of collateral, can theoretically underpin multiple layers of leverage simultaneously. The IMF estimated that before 2008, a single piece of collateral was being reused, rehypothecated, an average of 2.5 to 3 times across the global financial system. Some estimates place the total notional exposure of the global derivatives market at over 600 trillion against a world GDP of approximately 60 trillion. The collateral chain is the hidden plumbing of global credit. When confidence holds, it is invisible and functional. When confidence cracks, when one institution in the chain cannot return the collateral, the entire chain seizes. This is not metaphor. This is exactly what happened when Lehman Brothers filed for bankruptcy in September 2008, triggering an immediate global freeze in repo markets and interbank lending. Value at risk. The model that made the crisis worse, value at risk, or VAR, is the dominant risk measurement tool used by banks, hedge funds, and regulatory bodies worldwide. In its simplest form, VAR answers this question: what is the maximum loss this portfolio is likely to experience over a given time horizon at a given confidence level? A 99% one-day VAR of 10 million means there is a 1% chance the portfolio loses more than 10 million in a single day. The problem is structural. VAR is calculated using historical data. It looks backward, and it is precisely calibrated to the market conditions that existed before the crisis, not the conditions that emerged during one. As volatility spikes during a systemic event, VAR models tell risk managers to reduce exposure. Every institution using the same model receives the same signal at the same time. Every institution sells simultaneously. This creates a pro-cyclical feedback loop. Risk management tools designed to reduce risk actively amplify the very crisis they are supposed to contain. The Bank for International Settlements, the central bank of central banks, acknowledged this explicitly in its post-2008 analysis. The tools were working exactly as designed. The design was the problem. The 2008 global financial crisis resulted in an estimated 2 trillion in direct financial sector losses. But the total economic damage, factoring in lost output, destroyed household wealth, unemployment, the decade-long depression in productivity growth that followed, was estimated by the Federal Reserve Bank of Dallas at over 12.8 trillion in lost output for the United States alone. Global household wealth contracted by approximately 11 trillion in 2008. The U.S. housing market lost 7 trillion in value. Pension funds worldwide saw their valuations collapse by an estimated 5 trillion over 18 months. And yet, here is the concept of invisible financial loss. The deepest cost was never fully captured in those figures. The invisible loss is the decade of suppressed interest rates that followed. The Federal Reserve kept rates near zero from December 2008 through December 2015. This policy, intended to rescue the banking system, had a direct redistributive consequence. It transferred purchasing power from savers, retirees, pension beneficiaries, conservative investors, to asset holders and borrowers. It inflated equity and real estate prices far beyond what organic economic growth justified. It created the very conditions, inflated valuations, compressed risk premiums, record corporate debt, that now represent the next layer of systemic fragility. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, has described this dynamic as the long-term debt cycle a 75 to 100-year arc in which credit expands, asset prices inflate, debt burdens become unsustainable, and then the system deleverages, typically through some combination of austerity, inflation, currency devaluation, or outright default. Dalio argues we are in the late stages of the current cycle, with global debt to GDP ratios at levels that have historically preceded major monetary regime changes. The fear mechanism embedded in systemic credit risk operates on three frequencies simultaneously. There is the fear of insolvency, the visceral, immediate terror of watching an account balance approach zero. This is the fear that drives bank runs that drove 300 million Americans to watch their Forderungsig statements in 2008 and feel physically ill. There is the fear of currency devaluation, the slower, quieter erosion that happens when the monetary response to a crisis destroys the purchasing power of the cash you protected yourself with. And there is the fear of being wrong about what is safe. This is the deepest fear. Because it is not just financial, it is epistemological. It forces investors to question their entire framework. And without a framework, most people freeze, capitulate, or make decisions driven entirely by emotion. That is when systemic risk reaches inside the individual account and does its most lasting damage. Let us make this concrete. Let us talk about what happens not on trading floors, but in real portfolios, real careers, and real savings accounts. If you held a 60-40 portfolio, 6% equities, 40% bonds through 2022, here is what actually happened to your net worth. The S&P 500 declined approximately 19.4% for the year. U.S. aggregate bonds, the safe half of your portfolio, declined approximately 13%, the worst performance for U.S. bonds in over 40 years. A portfolio designed for diversification delivered simultaneous losses in both its major components. The 60-40 portfolio lost roughly 16% in a single calendar year. For a retiree with $1 million in savings, that is 160,000 gone from an allocation specifically designed to prevent exactly that outcome. Investors who held emerging market debt through the 2013 taper tantrum experienced drawdowns of 15 to 25% in instruments that were sold to them as stable yield vehicles. Within 18 months of the Federal Reserve's first signal that it might reduce quantitative easing, billions in capital fled emerging market credit. Currencies collapsed across Brazil, India, Turkey, and South Africa, and countless investors discovered that diversified, fixed income exposure was, in fact, a single correlated bet on U.S. monetary policy. Now let us examine the full anatomy of how systemic credit risk manifests across 6 dimensions. Portfolio impact. During a systemic credit event, correlations converge and drawdowns are simultaneous. Diversification fails at its moment of maximum need. Investors experience what risk professionals call liquidity spiral, where the need to sell illiquid assets to meet margin calls forces prices lower, triggering more margin calls, accelerating the downward cycle. The 2020 March crisis saw investment-grade corporate bond ETFs trading at discounts of 3 to 5% below their net asset value, a structural impossibility in normal markets. Career and income impact. The 2008 crisis eliminated approximately 8.7 million U.S. jobs within 18 months. Financial sector employment fell by over 200,000 positions. Bonus clawbacks implemented as banks took government bailouts, reversed years of accumulated compensation for tens of thousands of finance professionals. Entire business models, structured finance origination, leveraged buyout advisory, CMBS issuance effectively ceased to exist for several years. Savings and wealth impact. The Federal Deposit Insurance Corporation insures individual bank deposits up to $250,000 per depositor per institution. What most people do not know is that deposits above this threshold, held by small businesses, municipalities, and high net worth individuals, are unsecured creditor claims against the bank. In a European context, the Cyprus banking crisis of 2012 introduced the concept of bail-ins, where depositors above insured limits had their balances forcibly converted into bank equity. This was not theory. This happened to ordinary depositors in a European Union member state. Behavioral finance impact. During the March 2020 crash, Fidelity and Vanguard reported unprecedented call volumes as retail investors sought to move portfolios to cash at the exact bottom of the market. This is textbook panic selling, driven by availability heuristic, the most recent, most emotionally vivid information, falling numbers on a screen, overrides long-term probabilistic reasoning. Within 12 months, investors who sold at the March 2020 bottom had missed one of the most rapid recoveries in equity market history. The behavioral cost of systemic fear is almost always paid twice, once in the drawdown and again in the missed recovery. Risk perception failures. Overconfidence bias causes investors who have experienced a long bull market to systematically underestimate tail risk. Anchoring to prior highs. The cognitive tendency to evaluate current prices against recent peaks leads to holding positions far longer than fundamental analysis justifies. These biases do not exist because investors are irrational. They exist because the human brain is calibrated for an environment where most risks are visible, proximate, and physical. Credit markets are none of those things. Systemic blind spots, counterparty risk, the possibility that the party on the other side of your financial contract cannot fulfill their obligation, is the original systemic risk. AIG's near collapse in 2008 was not about AIG's own balance sheet. It was about $40 billion in credit default swap exposure that AIG had written, guaranteeing the credit quality of mortgage securities held by virtually every major financial institution on Earth. AIG was not a bank. Nobody was watching AIG's systemic exposure. Nobody had modeled what happened if AIG failed. Until it almost did, the unlearning process, and this is critical, is not about learning that markets are dangerous. Every investor knows that. The unlearning is about releasing the assumption that diversification ratings and conventional risk metrics provide meaningful protection during the events that actually destroy wealth. You are not becoming more pessimistic. You are becoming more precise. Here is the essential truth that the most sophisticated investors in the world have internalized. The goal is not to predict the Black Swan. The goal is to build a financial position that is not destroyed by it. These are not abstract principles. These are implementable strategies available to any investor willing to move from reactive to deliberate. Uncorrelated asset allocation, true diversification, is not about owning more assets. It is about owning assets whose returns are driven by fundamentally different mechanisms. Trend following managed future strategies, for example, have historically shown positive or flat returns during equity bear markets, including 2008, 2020, and 2022, precisely because they are not dependent on economic growth or credit expansion. Allocations to commodity producers, inflation-protected securities, and real assets provide exposure to different fundamental risk factors than traditional financial assets. Explicit volatility hedging options, based portfolio protection, specifically long put options on major indices, provides asymmetric payoff during systemic events. While the cost of maintaining this protection must be carefully managed, even a 2 to 3% annual drag can be worth its weight in a year where the alternative is a 30% drawdown. Inverse ETF allocations, managed with strict position sizing rules, can provide tactical protection during identified risk periods. The 3-bucket liquidity framework. Bucket 1, 6 to 12 months of living expenses in true cash equivalents, not money market funds with credit exposure, but FDIC-insured deposits or short-duration government securities. Bucket 2, 3 to 7 years of anticipated needs in intermediate assets, short-duration bonds, dividend-paying equities, assets that can be liquidated without catastrophic cost if needed. Bucket 3, long-term growth assets, equities, real estate, alternative investments, that you are genuinely prepared to hold through a 40 to 50% drawdown without needing to sell. The discipline is matching each bucket to its time horizon. The crisis behavior we described, panic selling at the bottom, almost always comes from bucket 3 assets being deployed against bucket 1 needs. Stress testing against history before your next market event. Run your portfolio through 3 historical scenarios. 2008, portfolio lost 37%, 1999 to 2000. The Nasdaq, you lost 78%. Bonds were the only safe haven. 1973 to 1974. Equities fell 48% while inflation ran above 12%. Cash and bonds both failed simultaneously. If your current portfolio cannot survive any one of these scenarios without destroying your financial plan, you are not diversified. You are concentrated in a different way than you think. Warren Buffett has said that diversification is protection against ignorance, that it makes very little sense for those who know what they are doing. That is not an argument against diversification. It is an argument for understanding what you actually own, why you own it, and what conditions would make it fail. The Black Swan rule of systemic risk in credit markets is ultimately this: the system is not designed to warn you before it fails. It is designed to appear stable until the moment it is not. The collateral chains are invisible. The correlation assumptions are embedded. The risk models are looking backward. Your job as an investor, as someone who has chosen to take this seriously, is to be the person who has already thought about what happens next, who has already sized their liquidity, who has already tested their assumptions, who will not be the one making a panicked phone call to their broker on the morning that everything moves in the same direction at once. As Nassim Taleb wrote, one extinguishes a candle and energizes a fire. You want to be the fire. Build a portfolio that gets stronger when the wind blows. Not because you predicted the storm, but because you prepared for every outcome the market is capable of delivering. If this analysis gave you a framework you did not have before, a clearer picture of the hidden architecture of risk, then subscribe to this channel, because every week we go deeper into the mechanisms, the history, and the strategy that the financial media does not have the time or the incentive to explain properly. This is the work, and you are now part of the conversation.